Hey, welcome back. It's Nolan Mathias from Mortgage 360. And one of the most frequent questions we get is why are we priced just a little bit higher than a lot of other brokerages? Why are we priced 0.1 or 0.2% higher than that guy you can find online or that interest rate aggregating website? And I'm going to tell you why today by telling you a story about how we saved one of our clients $29,000 recently. But before we get into it, do me that favor, hit that subscribe button, hit that notification bell, please hit that like button so more people like you can see this video. And don't forget about our race to 25,000 subscribers where one lucky subscriber is going to win $5,000 to put in their RSP, their RESP, or their TFSA. So go ahead, click that subscribe button. It's free, it's easy, and it's definitely worth it. The definitive guide on how to manage your credit, product, penalty, price in that order. It's never been more important to get your mortgage right. Okay, so let's get into it. Let's discuss why we're priced slightly higher and what that means. Because quite often when we get on phone calls with potential clients and we talk about the differences between paying, 1.45 and 1.35, and we talk about the fact that it's the difference of a price of a cup of coffee a week. Depending on the size of the mortgage, maybe it's one cup of coffee for an individual. Sometimes it's the Tim Hortons, sometimes it's a Starbucks. And maybe it is a cup of coffee for each spouse if it is a combined family and you're looking at a bigger mortgage. But the reality is that difference in price is typically pretty low when you look at it from a weekly basis. And what we always tell clients is that the reason why they want to deal with us is because if we do our job properly, they aren't going to care about the price of the cup of coffee a week because we're going to find opportunities to save them $5, $10, $15, $20,000 over the life of their mortgage, sometimes on multiple occasions. So, and that's what we're going to talk about today. And I'm going to tell you a story about how we did that this week with a specific client and how we saved that client $29,000. And this circumstance was built all around understanding how payout penalties work and figuring out how we can make a payout penalty that started at $32,000 and how we can make it significantly lower by bringing it down to around $2,400. And I'm going to show you exactly what I'm talking about here because this is kind of something that's been going around the internet lately. There's something that's called the Martin maneuver out there. And if you go and you take a look at Martin's Money Musings, just Google that and you can find the article. There is a gentleman back in December who found a means of reducing his payout penalty and by using basically a blend and extend, and then ultimately, and I'll tell you what that means in a minute, and then ultimately, after the blend and extend was complete, refinancing into a lower interest rate. Now, I love that Martin had found this loophole. I love the fact that he is calling it the Martin maneuver. However, this is something that Martin would have likely known about a lot sooner if he had a really great mortgage broker in his corner, because this is a loophole that is known quite frequently to a lot of different mortgage brokers out there. It's something that we've known about for many, many years. And it's not something that we always recommend because there are some risks involved with it, but it is definitely something that a good mortgage broker has a knowledge of. And specifically how to work around payout penalties is something that most mortgage brokers do really, really well, at least the really good ones. And the reason why is because the biggest opportunity for savings isn't so much about that 1.35 or that 1.45% interest rate. It is more about how you can save somebody big chunks of money. And most often the big chunks of money are saved when you can help a client avoid a penalty. So Martin went and found this maneuver, and then obviously there's been some articles and some YouTube videos written about it, specifically Jackie Cook. I'm not sure if I'm pronouncing that last name correctly, but he did a video on this, really great explanation. I'm not going to go into great details and the specific math on this because quite frankly, there is some risk associated with this type of maneuver, and you need to know exactly what you're doing. And it isn't always going to work for everybody. And as the banks figure out that the public is figuring out about this maneuver, they're probably going to try to put some fail safes in place in order to prevent you from being able to do it. Things like if you do a blend and extend, them requiring you to sign a document or agree to some sort of document. They sometimes do this over the phone that says that you cannot get out of the mortgage and basically put a bona fide sale clause in so that you can't basically do this maneuver. So, it's really an interesting conversation right now, and I'm going to tell you exactly how we did this for our client. So what happened is about 3 years ago, we helped a client get a mortgage with a big bank at a rate of 2.79 on a 3-year mortgage. Now at the time, the variable rate mortgages were actually priced above 3%, and you could get a fixed rate mortgage for less than the cost of a variable rate mortgage. That's the only time I typically recommend that somebody take a fixed rate mortgage, and I always recommend that they do it on a short-term basis. In this particular case, the client needed to go to a big bank. He needed a specific product that was only available at the big banks. So we helped him get that mortgage, and then lo and behold, everything happens in the economy, interest rates go down, and he's stuck paying 2.79% when the going interest rate is 1.45%. So he calls up his bank and he says, hey, what's my penalty if I want to break this mortgage? I have the ability to basically pay the penalty in cash, no matter what it was, and I want to lower it into a lower interest rate. And to his surprise, they say what we pretty much tell most of our clients when it comes to getting a fixed rate mortgage with a big bank, that the penalty is huge. And it was $32,000. So he calls me and says, hey, this is ridiculous. My penalty is $32,000. What happened? Why didn't we have a variable rate? And I went back and I kind of went through the details, and he said, oh yeah, I remember all of that. Makes sense. What can we do now to minimize this penalty? And I said, well, listen, there's this thing you can do with respect to a blend and extend. It doesn't always work. And that's the key here. It doesn't always work. It works a lot of the time. It doesn't always work. So if you're going to try this, you need to understand that you're taking some risk and you have to be comfortable with the rate that you're blending and extending into. So what I said is you can blend and extend. So what they'll do is they'll take today's rates and they will blend it with your existing 2.79 rate. And that will give you a rate somewhere in the middle that will be basically blended out for 3 or 4 years. So what he did was he blended and extended his 2.79 with a 1.69 rate, and he ended up getting a 2.04 rate for the next 4 years. Now, that was the first piece of the puzzle. And I said to him, I said, listen, if you do this, you need to be 100% comfortable with the fact that you're going to have a 2.04 rate for the next 4 years. And if you're able to do this maneuver and you're able to basically pay out the mortgage with a lower penalty, that's a bonus. So understand, 2.04, that's your worst case scenario for 4 years. If you're happy with that, go ahead and do it. And then we'll see what happens with respect to the penalty after you do the actual refinance, and then subsequently whether it makes sense to lower you into a lower interest rate from there. So that's what he did. He went and he got it blended. It took about 2 or 3 weeks for them to work it all out. And then once the mortgage was blended, he waited another couple of weeks and we had him call his mortgage provider and find out what the penalty was now. Now, here's the thing about interest rate differentials. Interest rate differentials are what makes the penalties high. So what happened in his case was he had 1 year left on the mortgage. He had about a 2% discount that they had given him initially. So the mortgage rate that they were comparing him to ended up being 0.79 because he had 1 year left. So that 2.79 less 2%. Now, he's paying 2.79, so therefore his penalty ended up being 2% for the remaining time left on the amount of money that was left on the principal. So that was what created that $32,000. Now, when he did the blend and extend, now he's got a brand new mortgage. And because he's got a brand new mortgage, he's got a discount off of what the existing rate is. So in this case, it was 1.7%. Now, when they go to do the interest rate differential, normally they're comparing to whatever term is comparable to the amount of time remaining on your mortgage. In this case, he's got a 4-year mortgage at 2.04%. So they're going to compare the rates to a 4-year mortgage. And therefore, the rate that they're comparing it to ends up being 3.74 less a discount of about 1.7%. So they're comparing 2.04 to 2.04. Which ultimately means there's no interest rate differential because the two interest rates that they're comparing are identical, which means he now has a 3-month interest penalty. So his penalty goes from $32,000 down to about $7,800. Now I said we saved him about $29,000. There's more to the story than this. So then what happens next is he says, okay, I want to refinance. I'll pay the $7,800 penalty, but I want to get a 5-year variable mortgage. What's the rate you can provide? And they say to him, sure, no problem. We can give you 1.45% on a variable if you pay the penalty. And he goes, okay, great. Is there anything you can do to reduce the penalty? And they say, no, sorry, sir, we can't do that. So in this scenario, I'm saying, well, I'll pay the penalty for you because I'm going to get paid a commission and I'll take you to a different lender. But I want to save you the trouble in this scenario because he's a busy guy and this is something that we do for our past clients. Even though we aren't going to get compensated, we want to help them do things in the simplest manner possible. What allows us to do this is the fact that we got paid our full compensation at the beginning rather than doing discounted interest rates. So I say to him, listen, I'm just going to send you an email, and I type him up an email while I'm talking to him on the phone. And I say, hey, Mr. Client, here's the interest rate I can give you. It is 1.45%, and I will pay your penalty for you. So he forwards that email then subsequently to his lender and says, well, I've got a broker who's willing to give me the same rate and pay the penalty. Is there anything you guys can do? And of course, they come back and they say, well, actually, there is. What we can do is we can discount the penalty by 20%, and then we'll actually give you an interest rate of 1.35 instead of 1.45. So in this scenario, with the discounted penalty and the extra discount on the rate, he effectively made his payout penalty about $2,400. So at the end of the day, he started at $32,000 for his penalty, and effectively to get down to a 1.35% interest rate, he ended up having to pay about $2,400 effectively in a penalty. So we saved him $29,000. So is this something that we do for somebody who walked in off the street? Probably not. We probably wouldn't spend the time. I'm definitely not going to give somebody who's a non-client an email that says I'm going to pay the penalty for them. But because this was a past client, somebody who had done a mortgage with us where we'd got paid a full amount of compensation, we're happy to help him do this and work through this scenario in such a way that he had to do the least amount of work possible. He didn't have to qualify, he didn't have to switch to a different lender, but we were able to save him $29,000 just by strategically giving him a little bit of information on how to work with his existing lender. Now, what's the benefit for me? I'm not getting paid on this. Well, this guy has now told everybody he knows about what we did for him. As a result, his family members are now coming to us to get a mortgage. A couple of his friends are coming to us to get a mortgage, all because we were able to help him with a payout penalty problem that if he had gone to a discount mortgage broker or a discount bank, he may not have been given the information he needed in order to do this. So the benefit to us is that when we do something to help somebody, it helps them grow. But the big thing about that is when we look at our brokerage and we look at why we do things, it's so we can help people save big chunks of money down the road rather than help them save a cup of coffee a week, end up with a bona fide sale clause, and then not be able to do the things that we just did for this particular client. So when clients call us and say, hey, why are you 0.1% higher than the guy down the street? That's why. Because we're more concerned about tens of thousands, 20s of thousands of dollars than we are about saving people cups of coffee. And if somebody wants to save a cup of coffee a week, I will absolutely help them with that. But most of the time when we talk to clients about what we do, how we do it, and we share with them the cup of coffee story versus stories like this where we save people $29,000 at a time, they decide to choose mortgages that are full featured, have more value, and ultimately when people understand value, they're willing to pay that little bit of extra price in order to have the ability to save significantly more down the road. So, this is one of those things. This is why we created Mortgage 360, is to help people. We also created Secrets to Getting the Lowest Interest Rate course. And the reason we created that course was so that people who aren't necessarily getting their mortgage through us can go ahead and get the same information that we provide to our clients so that they know about the landmines and the surprises of discounted mortgages, and they know about the things that can be done, like saving people $29,000 at a time by helping them understand their mortgage. So if you are somebody who is in the market and you aren't necessarily somebody who wants to come to Mortgage 360, or maybe you have your own broker or your own bank, you can get that Secrets of Getting the Lowest Interest Rate course by clicking in the link below. There's also a 50% off coupon in the description off the already discounted price. That course goes through things like how to negotiate with a bank and a broker, how much margins in a mortgage, and most importantly, the landmines and surprises that would prevent you from being able to do something like what I just talked about with respect to reducing somebody's penalty. So if you found this video useful, do me that favor, hit that subscribe button, hit that notification bell, please hit that like button so more people like you can see this video, and don't forget about our race to 25,000 subscribers. Somebody is going to win that $5,000, and I sincerely hope it's you.